Tariffs have led to, for the first time since 2017, a budget surplus in the US government in the month of June. We had a $27 billion surplus. Good morning and welcome to Life in the Markets. I'm Tim Russell and today is Monday, July 21st, 2025. It's great to be back with you today. Last week I was on vacation with my family and enjoyed a lot of the beautiful creation that God has provided to us by climbing mountains out in Washington State. It was a phenomenal time, but I'm ready to get back and talk to you about what's happened last week and what to think about as we head into the week to come. So last week, largely the markets were positive. We hit a couple more days of new all-time highs. This seems to be a common trend. The S&P 500 was up roughly around 0.5% for the week. We see all of the other indexes were largely in that general area. I think the Russell 2000 was up a little bit more than the S&P, and the NASDAQ was up more than the Russell 2000. So again, another positive week for the markets. Now, when we think about the markets and we see that we're hitting all-time highs, people could pause and say, well, hold on, the market's too expensive. I don't want to invest now. And from one perspective, they're right? We see today that the earnings multiple of the S&P 500, essentially that's how much is the company worth in terms of its annual profits. So if it's a 1 times multiple, it's priced at just 1 year's profit. If it's a 10 times profit or 10 times multiple, they're essentially pricing it in for 10 years of profits. If it's at a today 22 times multiple, we're looking at some pretty high expectations for the return of that company. We have a 22 times multiple, and I say it's a high expectation for return. That's actually inaccurate. What it tells us is that we're pricing the stock so high that we're going to take 22 years of profits to reach the current price of the stock. Now, that can cause a lot of investors to say, well, hold on, the market's too expensive. I don't want to buy now. And I understand that sentiment. I think a lot of investors will think that way. But here's something to keep in mind. People go back and they do these studies historically to find out how many days does the market trade at all-time highs. Did you know the number is 17% of the days the stock market trades at all-time highs? Now, if we just change the number a little bit and we say, well, what about how many days does the stock market trade around 5% of the all-time high number, like within 5% or higher, right, of that number? The answer is about 45% of all trading days are within 5% of the all-time high at that time. So that context helps to give us a little bit more perspective. Now, I don't want people to just go out and invest in stocks and buy expensive stocks because they're up. If you went out and bought NVIDIA because it was up 200, 300% in the last couple of years, it may have been good for a period of time, but NVIDIA stock has come back down. So we still encourage A, diversification, and B, I guess this is a sub-point of diversification. Don't have all your eggs in one company, own multiple companies, but also own multiple asset classes, which is why for our clients, for you, for many of the folks listening to this who are our clients, you have a wide variety of stocks, bonds, mutual funds to be able to balance out your overall risk. So if you think about putting money in today, it's not all going in the stock market. It's not all going in the S&P 500. We're putting that money to work in a variety of asset classes that are potentially more favorably priced in terms of the premium that we're paying Yeah, 22 times profit is a big multiple. Maybe we can get something with a lower cost. That would obviously be a good thing. So keep that in mind. Number one, it's not uncommon for us to be trading at all-time highs. It's not uncommon for us to be trading within 5% of all-time highs. In fact, 45% of all trading days are around that value. And we're not putting the money all in the S&P 500. It's well diversified in a broad grouping of investments. So continue to invest. Continue to trust the Lord. Don't trust my wisdom to look at the market and to know which direction it's going to go. Trust the Lord and trust the process. The process works. Moving on, as we think broadly through what else has been happening, inflation has been sticking around 3%. You know, the Fed wants interest rates to be around 2%, right? The Fed is the organization that the government delegates responsibility to make sure we have full employment, make sure we have stable markets. And they want interest rates, or inflation, I should say, they want inflation at around 2%. It's been really stubborn. It's been sticking around 3%. They're having a hard time getting it to their goal. Here's, I think, what I want you to know about that. Number one, guess what? Tariffs haven't blown up inflation rate yet. We're still paying attention to inflation. It might simply be too soon to see the inflationary effects of tariffs. But as of this point, we're not seeing a tremendous amount of inflation. The second thing I think you need to know about that is that the government has only limited control. They can set targets, but the markets are going to do, and the inflation is going to do what it's going to do. Obviously, there are policies that can be good or bad with regard to inflation, and I would argue tariffs are a bad policy with regard to inflation. But that leads me to my next point. Tariffs have led to, for the first time since 2017, a budget surplus in the U.S. government in the month of June. Get this. We had a $27 billion surplus. That means that revenue, income exceeded expenses by $27 billion. And do you know how much of that was accounted towards tariffs? $27 billion worth. Almost the entire amount of our budget surplus came from Donald Trump's tariffs. And the economy is still rolling along. We're still hitting all-time highs. The world hasn't come to an end. I know it's going to shock the people on CNN that that's the case. But again, we don't have to simply trust what the pundits are saying. Don't trust what people are saying with political agendas. Just look at the facts. Look at what the market's doing. The world has not yet come to an end. Now, we don't trust in Donald Trump. We don't trust in his ability to use tariffs or don't use tariffs, or pass a spending bill or don't pass a spending bill. We trust in God. But it's also important for us to recognize what the facts actually are and to inform the news that comes to us that's often biased, that doesn't necessarily look at the facts. Now, I do admit I have a political ideology, and I have certainly opinions and desires that I'd like to see worked out in politics. So I'm not claiming neutrality here, but I do think that we need to be very honest with calling strikes strikes and balls balls. I'm not a fan of tariffs, but they have been adding to the budget surplus, which is frankly what we need to start moving our debt lower. And that's one of the things that the government's really bad at doing. They have an office, I forget the exact name of the office, but they basically are responsible to take policies and look at what the budgetary effects of a policy is going to be. And they're notoriously bad at predicting revenue, at predicting future economic growth. So all of that to say, there's been more economic growth than expected. This is an encouraging sign. Let's continue to watch and see what happens. We don't invest based on the fact that the market's been up a couple months in a row or a couple weeks in a row. We don't invest just because of the current inflation read or the current economic outlook. We invest for long-term growth, not for today, but for 10, 15, 20 years in the future. So keep on investing with your principled approach. That will usually, almost always, I probably can't say always for compliance reasons, but just about always lead to success, right? Okay. The final thing I'll say is we'll continue to watch what's happening with the Federal Reserve. Jerome Powell, Donald Trump is talking about trying to replace him. I don't think he's going to be able to before his term comes to an end, which means that we're probably going to get the forecasted 1 to 2 rate cuts by the end of the year. If Donald Trump were to replace Jerome Powell, I would expect possibly 3 to 4 rate cuts. But again, it all depends on timing and when that replacement happens and how much time the new Fed has to implement his particular policies and agenda. So that's something to be aware of. All right. Economic outlook this week in the forecast. We've got a number of things happening. Earnings. We're in the middle of earnings season, actually the very beginning of earnings season. Last week we had a spate of really great earnings reports. Banks actually came back showing stronger health than expected. We see that the balance sheets are very robust. In the most recent stress test that the government puts banks through, they all passed with flying colors. So our banking system appears to be in really robust health. Things that we're looking for this week is we are going to get new home starts. We're going to get existing home sales. I think those numbers are going to be pretty important, as well as a few others. Earnings reports that we're looking for: Google, Tesla, Coke, IBM. I think Coke would be an interesting one this week to tell us the health of the American consumer as it relates to inflation in the products that they buy, because Coke has become such a bellwether for that within our society. All right. That being said, that's what I have for you today. If you have questions for things that you'd like to know or like for us to address in future Life in the Market episodes, reach out to us at contact@thelifegroup.org, and we'll be happy to take those suggestions. We also have, as far as things to look forward to, right now, I'm in the planning process with one of our financial advisors, Angel Sotomayor, who is a CPA financial advisor. We're going to be doing a deeper dive for you on the big, beautiful bill and kind of going through some of the components of it and how it may affect you. We're going to do a stewardship approach on that within our Stewardology podcast. So I'd encourage you, if you haven't subscribed to Stewardology, go over there and subscribe to that. It'll be maybe a month or two out before that comes to the stream on Stewardology. But we're going to do a deeper dive for the Life Financial Group here on this podcast channel. So make sure that you subscribe to that. If you are not already on our mailing list, go to our website, thelifegroup.org. You can add yourself to our mailing list there on the website and make sure that you get emails when these episodes come live, as well as an update when we do this larger, more detailed dive into the new big, beautiful bill and what it might mean for you and your family's finances. Now, on to the verse of the week. The verse of the week comes from Proverbs 21, verse 5. This is a favorite of ours in a lot of ways. It says this: "The plans of the diligent lead to profit as surely as haste leads to poverty." I don't want to create some mechanistic framework here that God is not imposing on Scripture. But he says in his wisdom that if we plan and we work and we strategize, we put effort in, that often yields success. But if we refuse to put the time and the effort to learn, to invest, to grow, to frankly get out there and work in your job and career, poverty is the result. When haste happens, when laziness happens, poverty is the result. I was reminded about this by a friend of ours, a friend of the Life Group. He sat down, was talking with some of our newer advisors, and he said, look, working works. When you get out there and you work hard, it tends to lead to success. It's not magic. It's the way that God made the world to work. So for you today, from a stewardship perspective, the Lord hasn't given you talents and opportunities. Take every opportunity to use your gifts and your talents to serve others and to excel in your career, and that will lead to success. We can trust the Lord. He is good and faithful. All right, until next time, take care. God bless. Be safe in the markets.
The topics discussed in this podcast are for general information only and are not intended to provide specific investment advice or recommendations. Investing and investment strategies involve risk, including the potential loss of principal. Past performance is not a guarantee of future results. Securities and advisory services are offered through Genius Wealth Management, member FINRA and SIPC.